IVM.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta B50 on Twitter, and on today's episode, we're going to be talking about the importance of fixed income and gold in your portfolio, in your asset allocation. Now, we've done a lot of shows over the last few months on investing during this crisis and how to sort your portfolio, where to focus more, and what to do. We've covered a lot of ground on the equity side. Stuff about index funds, ETFs, large cap, mid cap, small cap, and a lot of stuff, including from a top-down perspective of asset allocation. But I've never had anyone to talk about a very critical asset in our portfolio, assets actually, in our portfolio, which have a lot of potential. One is fixed income, and the other is gold. Now, fixed income could be of any type, and our guest will tell us about that. And investing in gold also now comes in lot of forms. You don't have to buy the actual physical gold as people would do at some point of time. Okay, so that's the topic. And so now let me introduce our guest today. So my guest is Saurabh Bansal, founder Finatwork, a SEBI-registered investment advisory firm based in Bangalore. So Saurabh, welcome to Paisa Vaisa. Thank you so much for doing this for the listeners. Let's start with a brief intro to yourself, your background, and how you started Finatwork.
Thank you for the introduction, Anupam, and I'm really glad to be here in the show. I grew up in a fairly middle-class setup. My father was a government employee. He was in the electricity board, so a lot of my early childhood was spent near power stations. Like most families, there was a lot of focus on education. So I went to IIT for engineering and then followed up with an MBA from IIM.
Wow.
Was looking westwards. So my work took me to, various places, initially in Europe and subsequently in US. But at some point of time, the calling took over. I wanted to come back home. I also was keen to try my hand at entrepreneurship.
Okay.
That's when the idea of Finatwork was born. Very soon actually we'll be completing 10 years of our journey as a
fantastic. So you guys, you started this advisory back in 2010. I think at that point of time there was no concept of a registered investment advisor and stuff like that. So 2010 must be such a different era, right?
It was indeed, Anupam. And, I'll be honest, it has been a very eventful journey. You're right, 2010, when I used to kind of approach the clients, real estate and fixed deposits, right? That used to be the primary investment avenue for most people.
And this is in Bangalore, I assume.
Yeah.
Pricing. Okay.
And capital markets and mutual fund used to kind of get a very limited share of the overall investment pie. So I think this whole idea was, you're right, ahead of its time. Who was an advisor and the need for an advisor was perhaps the last thing which was there in people's mind.
Sure.
Over the course of last 10 years, a lot of significant events have happened. Demonetization and GST, and that all led to formalization of savings. And that's where we are now, right? I mean, the capital markets have now come to the forefront, and the need for advisory has started to be felt.
Just to get this right for our listeners, you are a fee-only planner, right? I mean, if I am going to take your services, I have to pay you a fee, or do you offer other services also?
Yeah, so that was the whole idea with which, in fact, during this 10-year period, this whole concept of advisory was also born. So SEBI, came out with the investment advisory regulations in 2013, and they kind of segregated, this new class of, intermediaries separate from rest of them. So you're right. In the truest sense, an advisor is someone who gets compensated by its clients and not by the products they distribute.
Okay, understood. So now let's get into the current era. We are recording this somewhere in the middle of July, and my guess is it'll probably play out in August or in September. For the last few months, probably since March, we've had a massive crisis that's been going on the health front. Stock markets have of course been behaving in their own way. And in the end of March, of course, you had huge events happening. And the broad trend since then have been that equity markets have gone up. I think a few debt markets have also recovered and are doing reasonably well. And gold, of course, is in its own scene. Real estate, I think, is just generally frozen. So can you just walk our listeners through what's been your experience on the financial planning front for your clients in these past, four odd months? Any big trends that you were seeing? Any, when this entire thing from when this crisis started to where things are today, an entire progression of that. If you can just walk our listeners through what's been your experience as an advisor, then maybe our listeners can then figure out where they are in the entire scheme of things.
Sure. So as we kind of rewind and kind of go back to the start of this year, nobody expected 2020 would turn out to be such an eventful year. And you're right. I mean, there was a steep fall in equity indices across the world, right? All the major indices fell anywhere from 30 to 40%. And, Feb-March timeframe, as you would recollect, there was a palpable fear, right? As most of the, investors were kind of caught off guard. And then in times like these, I think, people realize the importance of asset allocation. And I kind of want to spend a little bit of time on this concept because, asset allocation means, different things to different people. So let me give you, an example of what I mean by asset allocation.
Okay.
So one of my friends, one of my clients actually, used to always insist on having 100% equity portfolio.
Mm-hmm.
And his argument was that, my provident fund, EPF, PPF, and, fixed deposits, kind of take care of the debt component, right? So all he wanted to do was, having 100% equity portfolio. And here's the point I wish to make, right? Looking at different asset classes disparately, right, as isolated buckets, kind of limits the beauty of asset allocation. So it's like, having 100% equity portfolio is like driving a car with only accelerator, right?
Okay, nice comparison.
So a car, right, needs to have a brake, it needs to have brake, it needs to have clutch, it needs to have gearbox, right, to be able to, run smoothly and kind of help you navigate. So in the same way, I think a good portfolio also need to have, debt and gold as much as equity, right? And this whole aspect of fungibility of money, right, rebalancing to be able to move money from one asset class to another, I think is what makes the asset allocation so beautiful, right?
Sure.
So there are different strategies, asset allocation strategies, which people use to decide upon what that weight would be and how it should be changed.
Correct.
But I think the macroeconomic environment, right, kind of supersedes all. I mean, it plays a very important role in kind of deciding which kind of asset class will do in what kind of environment. So it's almost like a season. Certain kind of plants and crops tend to do well, right, and some don't. So likewise, having a sense of where we are in the economic cycle can really help oneself in positioning, better for future. So for our clients, we had been actually reducing the exposure to equity from late 2017 to early 2018. And all that money was flowing into debt and gold during that time. So come 2020, most of our clients' portfolios were kind of underweight in equity. And, it kind of helped them navigate through this, phase fairly smoothly.
Very interesting. So I want to just ask you one thing out there. When you say that you started exiting the client's money out of equity, probably into debt or wherever else, the Nifty went at about 12,400 or 12,500 somewhere in Jan of this year. Jan Feb was actually a very good month for equity. Did you get any pushback back then, before this crisis started, that why is my money not in equities, or why is a higher share of my money not in equity? What was it like then? Because it seems so far away that I can't even remember what it was like. So do you remember that?
Yeah, so you're right. You're right. I mean, and it kind of sounds a little counterintuitive that you're kind of coming out of an asset class which has been doing well and trying to get into an asset class which is not doing so well. So if kind of just go back or go back by a year or two, gold wasn't such a great performing asset class. It had been kind of going sideways for many years. So of course there was a pushback, but I think as I said, I mean nobody knows what would be the trigger, but eventually I think the market kind of find some or the other economic trigger kind of comes in and kind of sets the tone for the future, right? So,
correct.
So that's how I think to kind of long story short.
Sure.
Basically, the allocation to other asset classes, right? Such as debt and gold is as important as equity in portfolio. And I think this whole idea of rebalancing, helps us weather the storm and makes the whole journey smoother.
What was it like in March? Let's get to the, let's get to the actual crisis time. What were your clients calling you up and, asking to do? Did you see a lot of withdrawals? A lot of people, coming out saying that I don't want to be invested. I need cash urgently. What was it like back then?
You know what, Anupam? I was actually pleasantly surprised during that period. I was also hoping, expecting, right? I mean, if you kind of go back to the previous crisis, 2008, we have all kind of heard about the industry numbers. There was a lot of withdrawals and SIPs being stopped and things of that sort. I think, I think that learning, right, has stayed with the investors. So what I found particularly was that, people were kind of far more measured in their approach. Everybody wanted to know. I mean, when every day the market is falling by 7-8%, people would kind of want to know where would it stop, or whether the right time has come for us to kind of start loading back the equities. But I think the response was far more measured. So I thought people were able to kind of at least our set of investors, mainly because their portfolios had been balanced and had a decent exposure. And if you recollect, right, both debt and gold have done fairly well in this period. So that provided them the stability and that comfort, that they were able to kind of pass through that period comfortably.
Did you have any people asking you that that we want to change our asset allocation big time and get into equities? Because data has shown that these last few months, people probably who are sitting at home have taken a very big interest in investing in stocks directly. So how did that? Did you see any trend out there over the last few months? Can you do you have any evidence or any experience to share to our listeners for that?
Sure. So, in fact, at our end also, I think we had, gradually as the prices kind of kept falling, and central banks kind of got into action, the interest rates started to go down. I think equity had again started to look attractive. So at our end also, we started kind of moving back money to equities. And you're right. I mean, as I hear about the numbers, the number of demat accounts which have been opened in US, I think there are these Robinhood traders who have also kind of come up in a big way. And in India, of course, Zerodha has kind of witnessed some of the largest account opening numbers in last few months. So yeah, this whole but the way kind of equity market has gone up has obviously taken a lot of people by surprise. In fact, I kind of experiencing that FOMO, that fear of missing out. Right, some of the people kind of might be feeling that maybe I'm kind of a little less exposed to equity than I should have been.
Sure. So in general, what was your experience with your clients? Did they what was the logic when they started to get into these stocks? Did they want to get into equities directly? Did they want to get into mutual funds? Did you actually, see this trend play out in front of you? People saying no, or maybe in some cases moving out from mutual funds and going directly towards stock? As is that something that stood out to you as a trend? Does that say anything for our risk appetite in general?
Definitely, I think the interest towards direct equity has increased. I think there is there is definite request coming from our clients to kind of have some portion of their portfolio directly going into stocks.
Sure.
And these crisis times also kind of throw open a lot of lot of good companies, right, at a very cheap valuation, right? So it's actually a good time to accumulate. But you're right. I mean, one cannot kind of one has to separate the trader's approach and an investor's approach to investing, right? And I think what you're referring to maybe at the industry at large. Maybe the SIP numbers continue to remain muted while at the same time these direct equity trading has kind of taken off. But I'm not sure whether it's a permanent shift.
Yeah, left to be seen maybe. After a year, maybe we'll know it. So one last thing before we end this first part of this episode, Saurabh, I want to ask you about this. Okay, somewhere in the, when the early days of the crisis in the third week or towards the end of March, we had a fairly largish crisis on debt mutual funds also, ranging from segregation of units related to any big component, of a loan, or the actual shuttering down of a few schemes. So that kind of is not something that you see very often. It's not even I think this is the first time in the history of debt funds in India that we've actually seen side pocketing of schemes happening, winding down of schemes happening. We even had a liquidity, almost came close to liquid funds, falling in value in the last week of March because of that massive liquidity crunch that we had seen. So these three are things that are not seen in debt mutual funds a lot. And of course, we've come a very long way from that. I think in some cases, some schemes that were side pocketed have been redeemed, and that's done. And we made a lot of very, very, very positive progress on that front. I want your opinion on all of this, on the issue of whether that changed the perception of debt mutual funds in your clients. Because we're going to be talking about fixed income on the other side of this break. So I just want to set the context right for our listeners. What's your view of these very rare events that happened in the debt mutual fund industry?
Glad you brought it up, Anupam, because I think debt as an asset class is not understood as well as equity. I think for most investors, equity is something which they have kind of seen and heard about. So when the equity market fell, it kind of came intuitively for people to kind of increase the exposure. They found value buying there. But debt, the understanding is very limited. And this whole space, right? I mean, if you were to kind of divide it, right? One is along duration, the other is along credit, makes it's a fairly, large space to kind of, but I mean, at the same time, it's very natural to put all of that in a single bucket. So I think the issues which you kind of talked about, right, were mostly around credit and liquidity. Our secondary markets in debt is not so deep and liquid. So when these redemptions started to hit in late March, some of the fund houses kind of found themselves in a severe liquidity crunch. Because as a mutual fund, they are supposed to provide that daily liquidity, but who do you sell it to, right? There were no takers for them, and that was a time when I think some of the debt funds, and you're right, first time in the history, had to actually shut off, and I think it kind of created that dent. And I think there was a point of time, and I was kind of reading that people were kind of started to look debt, found debt to be a little bit more risky than equity.
Yeah, exactly.
Which is kind of, against your finance 101, right? We all know that equity owners are the last one in the queue, right? When the liquidation, if and when it happens. of course, it kind of has that asymmetric payout. If it goes up, your kind of upside is limited to some extent, but your downside is unlimited. But if you look at the other side, the other dimension, which is along the duration, and look at the quality debt, right? Or your AAA or your PSU or the bank, right? All of that, I think that they did phenomenally well, right? All of them gave double-digit returns as we kind of moved later into the year.
Okay. Great. So, folks, we're going to take a break right now. When we come back on the other side of this break, we are going to talk about the concepts of fixed income and gold and why they're important from an asset allocation perspective. We'll also give you, Saurabh will also talk about, what in his opinion are some instruments which you could consider for investing in fixed income and gold. And we'll wrap the episode with his outlook for the near future for his clients and also for our listeners. So don't go anywhere. We'll be right back on this episode of Paisa Vaisa.
I want to thank Intel for supporting our show. Do you remember when last year we spoke about how the Intel vPro platform is built for business? Well, I'm glad to say we've kicked things up a notch. That's right, Intel is back with a new and improved version of the platform. Optimized with 10th generation Intel Core processors, the platform is just what IT and business users need, especially in times like now when most of us are working from home. The new Intel vPro platform lets you do more of what you want and less of what you don't. So it's better for you and for your IT teams, who really are the backbone of keeping your work from home experience easy and enjoyable. The platform is built to minimize your efforts and maximize your PC productivity, especially when working from home. I can safely say that the new vPro platform gives you more enterprise efficiency with less constraints. Visit intel.in/morewithvpro, that's VPRO, to discover how you can get more done with less waiting. If you're listening on the IVM Podcast Android app, take a look at the screen right now and you'll see a link which will take you directly there.
And welcome back to this episode of Paisa Vaisa. My guest today is Saurabh Bansal, founder Finatwork, a SEBI-registered investment advisory firm. In the first part of this episode, we spoke about what's happened in these last few months after the crisis, during the crisis. We spoke a lot about how Saurabh has actually managed to take his clients away from equity in the early parts of the crisis throughout. That was a strategy that he had followed for his clients through I think end 2017 and 2018. He also spoke to us about how debt mutual funds have performed in the early part of this crisis. So since we are talking about debt mutual funds and since this episode is about fixed income and gold, so Saurabh, let's start with this. Why do you think fixed income and gold is important from an asset allocation perspective? I like the comparison that you gave in the starting. When you said that if you have 100% allocation to equity, it's like driving a car with only the acceleration on. So now talk to us about the gears, talk to us about the clutch, talk to us about the other parts of the car that you think are important.
So Anupam, history is a great teacher.
Sure.
So a lot of learnings, if you kind of go back and look at the past recessions, you'll notice certain patterns actually coming out. One thing is the role of central bank. Usually during such periods, the central banks become very, very active. They kind of use all kind of monetary tools which are there with them. They'll start by cutting interest rate aggressively, and as you know that kind of interest rates and the bond price have got inverse relationship. So all the debt, it kind of adds to the performance of all kind of debt funds. So if you look at, say, even in Indian context, right, as we speak now, all the funds which are, say, gilt funds or your dynamic bond funds or banking and PSU debt, all of them have done phenomenally well during this period, right? So debt provides that natural hedge, right, when we kind of get into a recessionary kind of phase. And I'm kind of limiting myself to the quality debt. Because the other element, and we briefly kind of spoke about it before the break, the credit quality does not do as well because, the companies are still struggling and trying to come out of the recession. But as the interest rates are cut aggressively, the debt and debt portfolio tend to do well.
I was just going to ask you about gold. Go on.
Yeah. So let's turn our attention to gold, right? So ever since Bretton Woods was abolished, all the major currencies across the world have been depreciating against gold. In fact, I came across some data from the turn of century, early 1900s to now. Almost all the major currencies have lost anywhere from 90 to 95% against gold. And every recession leads to further depreciation, right? So, say in Western world where the interest rates have already hit zero, the next tool which central bankers tend to use is to start printing money. The money which kind of we use, right? It's a fiat currency. So, I mean, in real terms, it kind of loses its value. So this time alone, I think during that period, we talked about Fed had expanded its balance sheet by almost $3 trillion.
Yes.
In a very short period of time. And kind of, that led to the, outperformance of gold during this period. And that's what makes gold so unique. It may not produce something of economic value like equities, but it is still, such a important, part of any portfolio.
Interesting. So, are you, would I be right in assuming that you feel that gold tends to do well in a crisis? Because probably because of this trend of central banks monetizing their debt or printing money, whichever way you look at it. And that's what's been the case. I think that happened in the 2008 crisis. It's happening right now. Also, gold prices have just been through the roof. So do you think that's the reason probably?
It is. I mean, and historically, if you just pull up the chart of gold,
right.
It's the same pattern repeating again and again. You're right. 2008, we have seen that remarkable, rally in gold which happened, and the recent past, right? We have that data. Gold is kind of touching almost all-time high. So that's what kind of makes it such an important, piece of the whole portfolio. That car analogy we talked about.
Yes. So two questions here, Saurabh. Now, one is in terms of percentage exposure to each asset class. What's your general view on over the lifetime of an investor? Which could be anywhere between 20, 30, 40, 50 years, depending on the age of the investor. So that's the first question. And second, the next logical one is what are the best instruments that you feel that if anyone wants to have an exposure to fixed income and gold, what would be the way to go about? So let's start with this asset allocation in terms of percentages between various asset classes. In your view, how does it pan out over an investor's life cycle?
So, people use different asset allocation strategies, and frameworks to decide the weightages of each of these components. Broadly speaking, there are three. There's a strategic asset allocation wherein one kind of look at, one's risk appetite and time horizon of the goal, and then take a call that, maybe, I'll have a 60 or 50, 40, 10, right? 50 equity, 40 debt, and 10 gold.
Yeah.
And try to kind of rebalance as and when kind of, they get unbalanced. For instance, if there has been rally in equity and kind of goes up, the weightage goes up, you kind of rebalance and bring it back to the original weightages. That's one approach. The other approach is a tactical asset allocation, where kind of people take more of a rubber band kind of approach. That is, these numbers are not kind of cast in stone. There is kind of maybe 10% of rubber band on both sides, and based upon my view of a particular asset class, I can take a call whether to go to 40 or 60 as well, right? Giving it a little bit of liberty and room to kind of move around. And the third is, which is what we kind of follow, is kind of a dynamic asset allocation approach, wherein we look at the macroeconomic environment and where we are in the business cycle. Okay. The reason I refer to that 2017-18, right, late 2017, early 2018, because we were getting sense that we were kind of at the peak of the economic cycle, of the business cycle, and there were signs of, kind of on the way down. And therefore, we kind of positioned ourselves a little differently. And we kind of went underweight in equities than usually one would be. So we were kind of severely underweight in equities during this whole period.
Sure.
and an overweight on debt and gold.
Okay, the best instruments now. If someone, wants to get into fixed income and gold, what would you tell them?
So, we Indians have been accumulating gold for many centuries. It's kind of part of our tradition, right? Marriage ceremonies to anniversaries to festivals, Akshaya Tritiya, Diwali, right? Gold has been part of our culture. So physical gold, right, in many of its forms, coins, bar, jewels, is something we have all seen pretty closely growing up. What is interesting is that there are some interesting innovations which have come up. So, for instance, sovereign gold scheme has been a very interesting innovation introduced by RBI, wherein one can also earn interest while the underlying asset kind of moves along with the gold price.
I wanted to explain that this SGB, the sovereign gold bond concept, was because it was just open, now of course we're in July, so it was open a while ago. I just explained to our listeners how this instrument works because I feel that a lot of us still don't properly understand it.
Sure. Sovereign gold bond is a very interesting innovation. So unlike a physical gold, which kind of has all the issues of buying and storage and all of those, this kind of takes away a lot of hassles. In a sense, it's a kind of a promise, a sovereign promise to kind of have, holding gold in a paper form. And what makes it interesting is that, you kind of get incentivized and earn, I think at the moment, the interest rate is around some 2.5% or so. And typically the time frame is around, say, 7-8 years. And if you kind of, give it back and whatever is the underlying gold price, which has moved from the time you purchased to the time of closure, you get to have that appreciation. What also makes it interesting is that, there are some tax advantages associated with it. And there's some bit of liquidity also which comes after the 5th year.
So that means that, so you buy it at today's gold price, you hold on to it. And so this is a liquid instrument. It's not close-ended, right?
It is kind of close-ended, at least for the first few years.
Okay.
And, after 5th year, one can actually buy it in the secondary market. But the market is not so liquid at the moment, right? So you probably may not be able to realize its true price.
Sure. And the capital gains on this, like if you buy at 100 and say that, the price actually doubles after 5 or 7 years, then you sell it back to the government or back in the primary market or secondary market at 200. So the capital gains, what would be that?
Yeah, so that's where the tax advantage also kind of comes in. If you kind of sell it back, right, to RBI, I mean, you kind of hold it on over the entire period. So the entire capital gain tax can be avoided. But if you sell it, of course, in the secondary market, then the capital gain tax implication.
Sure. Go on, please. You were talking about sovereign gold bond as probably the best way to invest in gold. Would I be right in saying that?
Yes and no. So if you kind of go back to the fungibility part of the asset allocation, right? And that's where I think the other two forms, right, the gold ETF and gold mutual fund, find their merit. Because it's far easier to do the rebalancing if you wish to kind of take a tactical call on gold, right? If you think that maybe this rally is around for a year or two, it's far more easy to actually buy it over the as an exchange traded fund or as a mutual fund.
Okay, so would that be it? I mean, we've covered fixed income, we've covered gold. Would that be the list of instruments that you would be recommending to your clients if they want an exposure to these asset classes, right?
So I think we talked about gold. So maybe I can spend briefly about the fixed income as well as we speak. So see, fixed income market is far bigger than equity market globally. But when it comes to India, the options are quite limited as far as the retail investors are concerned. If you look at, say, the primary market, right, there are very few issues which come in the primary market open for the retail subscription. and you have to kind of wait for the window to open up. Secondary market, unfortunately, is not so developed, not so liquid. So the bid-ask spreads are big, and the market. I mean,
so you're saying that if someone actually wants to buy a debt instrument in the market at a retail level, it's obviously not very easy for him to do. Like if I want to buy a government bond or an NBFC bond or something of that sort, the probably the procedure and the choices aren't that available to me.
That is correct. Okay. Even G-Secs, right, are unlike say Western markets, are not that easily accessible.
Sure.
So kind of debt mutual fund seems like the most convenient route, at this point of time.
Okay. So I think you also have the Bharat Bond ETF also, which came out. Do you have any view on that? Because that I think opened up a completely new asset class within debt for a lot of people.
Yeah. I think that is again a very interesting concept. Bharat Bond, and and then in fact the first subscription when it came, right, from the time then the interest rates have actually gone down, so it has also done well. And I think I've seen kind of a lot of interest when this new issue has come up. So you're right. I think ETFs going forward are going to be, is going to be another possible avenue for investing in this space.
Sure. Okay, Saurabh. So that's just about it. Let's close on what's your call now going forward across categories, whether it's equity, whether it's fixed income, whether it's gold. What are you telling your clients from a strategic perspective, tactical perspective? What should they be doing now going forward, from your financial planning perspective? Let's end on that note.
Sure. So, unlike the past recession, COVID is a health crisis. Something which we have kind of not seen for decades. So I doubt I have that expertise to kind of guess how will this whole thing play out. But I can definitely share what we are doing in our clients' portfolio. So after that serious correction, which happened in March, we had started to build back the equity positions for our clients. This rally might have, did catch us by surprise, but I think the way to go is to kind of, start building back those equity positions. Secondly, on the debt front, we are kind of sticking to the middle and avoiding the either end of the duration. So we are kind of staying to the low to medium duration of funds. The interest rates have actually come down quite a bit. So,
so that means that you would not be looking at something on the shorter side, like an ultra short or something of that, an ultra short or credit risk, and you would not be looking at the longer term yield also. Would I be right in assuming that?
So when I meant by what I meant by short was at the very short end. So I would kind of avoid the liquid and the overnight.
Sure.
I would still be there with low and medium duration. And you're right, the other extreme end, right, being the high end of duration is something which at least we are not comfortable with.
Okay.
Sure. Gold seems to be at an interesting level. And rather than looking at the price movement, I think we should kind of look at the central bankers, what they are saying, what they're doing, because I believe they'll continue to play a very important role as we kind of navigate out of this crisis.
And they seem to be spending away. So,
correct. So, as an investor, I think asset allocation will continue to remain critical. So, all we are doing is making sure that our accelerator, our brakes, our clutches, and gearboxes are well oiled, working well for the journey ahead.
Okay, well, let's all hope that we have a pleasant, or at least a uneventful journey ahead. Because what we've all been through in the past has been pretty rocky. Folks, that is a wrap on this episode of Paisa Vaisa. Just a disclaimer that the views shared in the podcast are the personal views of the guest and do not represent financial advice. Please consult your financial advisor before making any investment decision. Saurabh, thank you so much for joining us today. Folks, that was Saurabh Bansal, founder, Finatwork, a SEBI-registered investment advisory firm. Saurabh, thank you so much for joining us today.
Thank you. Thank you so much, Anupam.
And listeners, if you like this podcast, don't forget to check out other interesting podcasts on the IVM network. You can listen to us on the IVM Podcast app or ivmpodcast.com. You can also follow us on our social media. We are IVM Podcast on Twitter and Instagram. And if you want to reach out to me, I am B50 on Twitter. And thank you so much for listening to Setup.
No material on the show should be considered as financial advice. The material on the show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
I hope you enjoyed that show. I'd like to thank our sponsors, Intel, for coming back to us. We love our sponsors. If you'd like to be one of them, do reach out. So really cool week on the network this week, right? Started off with a bang. Abhijit Ganguly was on Cyrus Says. Funny comedian. I think you guys will enjoy that. We had Dimant Parekh on Advertising is Dead. Dimant's the founder of Better India. Govindraj Athiraj is also on Uncle Please Sit this week. That's a really fascinating show which they talk about fake news. On the Habit Coach, there was a crossover event with Aditi Surana from Absolutely Right. I think you definitely enjoyed that. And last but not least, definitely a show I'd love you all to check out. We have a new show called This Round Is On Me. It's hosted by Gauri Devi Dayal. If you remember, Gauri and I worked on a show together called The Kolaba Cartel a while ago. Fun show. If you haven't checked that out, do check that out. But this is a show where she's talking to a lot of different people in the food space. Her first guest is Harsh Mariwala, legend in his own time. I think you'll really enjoy that show. But with that, we hope to see you again next week.
Namaskar, this is Ashish Vidyarthi. Yes, my friend, these are challenging times, but in these challenging times, we can create something extraordinary. Do take time to listen to my podcast, Begin the Journey. Available on the IVM Podcast, website, app, or wherever you listen to podcasts. Remember, we have a great opportunity called life. Cheers.
Have you ever wondered how successful people do their thing? How do they navigate the challenges they often face? Are you wondering about the future of restaurants, film, education, technology, and everything else in between? Hi, I'm Gauri Devi Dayal, best known for being one of the brains behind The Table, an award-winning restaurant in Bombay. One thing my life as a restaurateur has given me is the opportunity to meet with some truly inspiring people, most often just by chatting with strangers at the community table. And that's what this podcast is about. It's about learning the new dimensions of business and understanding how different people swim this sea. It's an opportunity for me to pick their brains and ask them all the questions on my mind, whether it's about learning from their past experiences or talking about future trends. Through their journeys, stories, and insights, I hope you too, like me, will come away inspired and energized. So come, join me every Wednesday with your favorite drink because this round is on me.